Hey guys, welcome to the first video for FIN or Financial Reporting, one of the key CA modules. So I'll just be diving into the first chapter. We'll be preparing our video based off the notes you've been provided. So my first step, as always, I recommend just downloading those notes from the website so you can scroll through them at the same time. Anyway, I'm just going to jump into the first chapter, which is just an overview of financial reporting. This isn't the most important chapter by far. This is just very generic stuff, a lot of which you won't actually need for your exam, but I'll run through it, at least on a high level, just so you kind of understand for your own benefit the background as to why certain standards have been developed, certain rules, but let's just jump straight into it. So, first of all, I want to just run you through what the International Accounting Standards Board is. And what's happening generally with accounting standards. So accounting standards are what the rules in terms of how you have to apply a certain principle for accounting, and also some certain definitions to ensure consistency. The International Accounting Standards Board is the board that overrules the international accounting standards. They're a set of rules which I guess most countries or all countries kind of have to apply in their accounting standards. Subject to some small variances depending on location. So, I mean, historically there's been some significant differences between certain countries, particularly with the US and Australia, for example. But there has been a historic trend to kind of bring those two standards together. It's called converging of reporting standards. Now, it is an important trend because it does make cross-comparison of countries' accounting or financial reports much more consistent and transparent. And also another key benefit is it actually reduces the cost of capital for investors and companies to borrow money because of, it's easy to compare the two, and it just makes accounting information more accessible to end users such as banks and shareholders, etc. So it is a good trend overall. So I'll probably skip through this one quickly. This is just kind of outlining how the Conceptual Framework interacts with the International Accounting Standards Board. So the Accounting Board develops the Conceptual Framework, and this is the set of rules and definitions as to how to set out your, accounting and financial reports. Again, it doesn't come up in exam questions very often, so I'm just going to move forward quickly. So this is just talking about what the Conceptual Framework is. So the Conceptual Framework is a set of, objectives, characteristics, definitions and recognition criteria, and concepts of capital, in which kind of sets the basic rules as to what is categorized in certain ways, so everything is consistent across countries. For example, we're going to talk a little bit down here about the definitions of assets, liabilities, equities, income, and expenses. So let me just touch on this first. So general purpose financial reporting. So we'll touch on this a little bit later in terms of what the difference between that is and special purpose financial reporting. But just on a high level, general purpose financial reporting is financial reporting which adopts the Conceptual Framework or the International Financial Reporting standards. So, qualitative characteristics that are set up by the Conceptual Framework is the definitions of assets, or the recognition criteria of assets, liabilities, equity, income, expenses. So, you would have learned these in university and even high school, really. So, I'm not going to really touch on these in great detail. But an asset, just on a high level, is basically a present economic resource controlled by the entity as a result of past events. So to break that down, so it's a present economic resource, for example, cash, controlled by the entity. The entity can determine what happens with that bank account as a result of past events. So that cash is sitting there because of a past event, such as a sale. A liability. So a liability is a present obligation of the entity to transfer an economic resource as a result of past events. So a present obligation, it's not a past obligation, it's present. To transfer an economic resource, for example, cash, or it could be a reduction in liability or anything which may generate future economic benefits as a result of past events. Again, it might have been due to a previous lawsuit which has resulted in a contingent liability to pay out that cash. Equity. So equity is basically the difference between assets and liabilities. This is all this formula is saying. Income is just saying increase in asset or decrease in liability that may result in increase in equity. So they've only brought in the equity because of the how that relates to the ALO formula: assets, liabilities, owners, equity. Expenses. So it's a decrease in asset or an increase in liability that may result in a decrease in equity. And I'll just skip over economic resource. It's basically just anything that brings future economic benefits. So they're just pretty high level stuff. Most of you will just generally know what an asset is. The only really time that it might come up is in your quizzes, when you might be tested on the definition, but again, it's not really worth a lot of marks. Okay, so just skipping over to this. So practical issues in accounting standards. So probably one of the first practical issues is just the differences, the small differences between Australian accounting standards set by the AASB, Australian Accounting Standards Board, and IFRS, or the International Accounting Standards. So IFRS sets the base definition for all countries to follow, but then in certain situations, depending on cultural differences or national economic differences, there might be some variations to these standards, and you'll see these because there'll be an AASB one instead of an IFRS. So you'll know that that's when there's a slight variation to the International Accounting Standard. So this is the national reporting requirements. This is basically how the Australian accounting standards interact with both the Corporations Act, so legislation, also the board, which oversees the Conceptual Framework, and also just other parts of the Australian economy and financial and capital raising environment. For example, the ASX, there's no direct correlation, but the ASX has certain listing rules for listed entities, in which kind of overlaps with the Australian accounting standards because they need to follow general purpose financial statements, i.e. follow the accounting standards as a listed entity. We'll talk about that a little bit more. There's also a very slight correlation with this Accounting Professional and Ethical Standards Board, just because they set a code of ethics and professional standards for accountants to follow. There's not a lot of close correlation between the two. We're mainly going to focus on Corporations Act, but not so much, more so how it influences AASB. We're just going to focus on this mainly, the standards, the board, and the conceptual framework that the board develops. Okay, so standards and legislation affecting financial reporting in Australia. So we're just going to focus on Corporations Act up here. So the Corporations Act influences accounting standards in two ways. One, it determines which entities are required to prepare a financial report in Australia. And number two, it determines what are the main components of a financial report. So, the types of entities that need to prepare a financial report in Australia are entities operating under Corporations Act 2001. We'll talk about these in a little bit. And also entities with reporting obligations under other legislation. So these are basically these three here. So, disclosing entities are the main one. So the definition is basically, if it has any enhanced disclosure securities, it is a reporting entity. So the most common one is just basically a stock listed on the ASX or a stock exchange. But it also includes entities that have raised funds by way of a product disclosure statement, PDS, for example, a managed investment scheme. So basically the key takeaway from this one is, if it's listed on the stock exchange, it's a disclosing entity and there's additional reporting requirements. For example, a disclosing entity must also prepare a half-year financial report under Corporations Act. Public companies is another one. So a public company is defined under Section 9 of the Corporations Act as a company other than a proprietary company, i.e. a Pty limited company. It includes listed companies and it includes companies limited by guarantee, for example, a charity. Not a charity, a club is often a limited by guarantee. It's a group of members together. So public companies have specific reporting requirements, in particular content that must be included in director's report. And the last one we have here is proprietary companies. Proprietary company is either a company limited by shares. This is just your standard Pty limited company, by the way, or unlimited company with share capital, which has less than 50 non-employee shareholders. In addition, proprietary companies cannot offer securities for sale except in limited circumstances. So, there are some certain reporting requirements, and this is important because it does come up in questions. So large proprietary companies, so a large PTY limited company, so not listed on the stock exchange, just a normal private company, must prepare and lodge audited financial report. A small proprietary company are not required to prepare and lodge any financial report. So a key thing to look out for in questions is whether or not, okay, so it's not listed, because we know if it's listed, they've got general purpose financial reporting and possibly also half-year financial report. But we know that as a private company, it generally doesn't have reporting requirements unless it's a large company. So we need to know what a large or small proprietary company definition is. So just before I go into this, so just as a side note, so all of these entities, disclosing entities, public companies, and large proprietary companies, in addition to their unique reporting requirements, the most important part is all of these three entities must prepare an annual financial report which is lodged with ASIC. Okay, so now back to the definition of large or small proprietary company. So, a large proprietary company is required to prepare and lodge a financial report with ASIC, as we mentioned above. However, the threshold for this are these three things. Now, if it falls below the threshold in 2 or more tests, it's a small company. Otherwise, it's a large proprietary company. Okay, so let's go through these. So revenue, 25 million. Consolidated gross assets at the end of the year, 12.5 million. And employees at the end of the year, 50. So just try and remember these. So let's give you an example. So let's talk about a company that's got 24 million revenue. It's got 12 million gross assets at the end of the financial year. And it's got 52 employees at the end of the financial year. Is this a large or small company? So let's just go through and see if it fails or passes the test. So the first one, we said it's going to fail that because it's below the threshold. Second one, we're going to fail that one because it's below the threshold. And the last one is it passes that one because it's above the threshold. So now let's go back to the definition. And it says, if it falls below the threshold in 2 or more of these tests, it's classified as a small proprietary company. So it failed the first one, failed the second one, therefore it's a small proprietary company under Section 45A of the Corporations Act, and it is not required to lodge a audited financial report with ASIC. End of question. So that's the type of question you might expect in an exam. Okay, so if you are a small company, you are required to prepare a financial report in certain situations. It's not common though. These are those situations. So number 1, shareholders with at least 5% of the vote direct the company to do so. So these are basically minority shareholders who want financial report. They can specify under Corporations Act, Section 292. ASIC directs the company to prepare a financial report. So they can direct any company to do that, Section 294. Or number 3, it's controlled by a foreign company and was not consolidated in financial statements lodged with ASIC. So basically any entity controlled by a foreign company needs to be, and it's not consolidated with financial statements lodged with ASIC, ASIC needs to see it basically. So this is talking about the difference between financial statements and a financial report. So this is always a little bit confusing. Financial report is the more comprehensive one. Financial statements is the bare minimum. So a complete set of financial statements goes into so this is what goes into a financial report. So in addition to these, so this is just straight financial statements, statement of financial position, statement of profit and loss and other comprehensive, or other words, a P&L, statement of other changes in equity, which is just your equity statement and how that's changed, statement of cash flow, comparative information for each of these reports, and notes. Now, in addition, a financial report also needs to have these information. So it needs to have everything that we mentioned before in the financial statements. It needs to include notes to the financial statements, including disclosures required by the Corporations Act. And it needs to include director's declaration, which is basically a statement signed on behalf of the board which covers a number of assertions, including a statement of solvency, i.e. that it will pay its debt when they become due and payable, and also the statement of compliance. so that the financial statements give a true and fair view of the entity's financial position. There are certain situations in which you don't need to prepare financial reports in which you otherwise would because of the above rules. Number one is ASIC class orders. It's basically an exemption because ASIC has specified that you do not need to do that. And ASIC regulatory guides. It's basically the ASIC releases the guidance which explains when and how they're going to exercise their powers. Okay, so let's just skip through and we'll go to this point we talked about before. So it's the difference between general purpose financial statements and special purpose financial statements or reports. So general purpose is designed to meet the groups of a wide group of users, for example, shareholders, stakeholders, etc. So anything which is a public entity needs to have general purpose financial reporting. Now, special purpose is tailored to meet the needs of a specific group of users. If it's just a small private company, you only need to prepare special purpose financial statements unless ASIC says otherwise. So this is just a flow chart which basically just summarizes what we just talked about, which you can use to figure out whether it's a general purpose or special purpose reporting, whether it's disclosing entity or not. However, it's just summarizing what I've already said. And if you've understood what I've just told you, you don't necessarily need to follow this flow chart. But if you prefer to think in that kind of context, please go ahead and use this. So these aren't too useful. They don't really come up in exams too often. It's just talking about the difference between tiers of reporting, different tiers between general purpose. But again, it doesn't really come up in exams that often. This is a section that does come up in exams a lot. So it's ethical requirements in preparing financial reports. There seems to be a lot of questions, especially the 4 to 5 mark questions, in which you actually have to identify which of these, threats to independence might come up: self-interest, self-review, advocacy, familiarity, and intimidation. However, we're going to cover these in the next chapter. So we'll touch on these a little bit later. As you can see, it's quite a long chapter, but we'll come back to this shortly in the next video. Thanks for watching. We've covered all the key points in chapter 1, so if you want to revise, watch it again, or read through the notes yourself, that'll help with your learning. Otherwise, I'll see you in the next video.